Something different first. Mark says, married put question. Income method number one, selling call. From my understanding, one of the potential issues we could face is that we could lose if the stock takes off too quickly due to the put. It's not losing, Mark. It's just you're missing out on the upside because you've made the choice to sell the call, which caps it, okay? Which is why we don't do this method on the opening rate. Based on that being true, why can't we move the put, income method number four, to help reduce the chances of that happening? I do realize that the stock skyrockets, not much you can do, but outside of that, oh no, it's okay. So outside of that, this could be used as to help manage income method number one or ratio trade income method number five. No, Mark, it's the opposite. Okay. I'm in a married, let's go to my portfolio. And let's go to the radioactive trades. And perfect. Did I roll it? I haven't rolled it yet. Okay, I meant to roll it. I haven't rolled it, but that's okay. Allies, not good. Berries. Berry's better. Use berry. Oh, no. Okay, I'm sorry. I'm going to stick with Masco, Mark. So if I'm understanding your question correctly, Mark, saying here's this position. I've got a 4.8% risk. This is an actual married put in the Fusion portfolio, but I've already rolled the July 60 put up to the 65 strike where it is now. I'm going to hold off on that for a moment. And the risk is down about 1%. I still have infinite upside. Haven't sold a 65 call yet because earnings is coming out next week. Wait, I apologize. This is the one that's coming out on 5/6. So no, I'm still waiting. I don't want to sell the May call in this case because the earnings are coming out and it might jump up to 70 or 75 as you're talking about. But let's say ignore all that. Stock has moved up as I expected. I'm looking at a good return on the position. We're going to go ahead and sell the May 65 right now for $1.70. Okay, so we had the married put with the limited risk. I just used an income method number one to generate premium against the position. Let's clean up this graph a little bit. There we go. What did this do for me? It reduced my risk from 4.8 to 2.2%. Max return of 7.3% if the stock is trading at the short call strike price. But as you see, the profit tails off at the end. And if I had done this at a lower strike price or at a lower premium, we'd see a profit and loss chart that might look something like this, where it really tails off and might enter into a loss up here. Why? Because at the near-term expiration of May, if the stock goes above my short call strike price, that in-the-money call is quickly going to a delta of 1. My 60 put is still at a delta of 0.4, now that it's out of the money, or 0.3. What this means is I'm still losing 30 to 40 cents for every dollar the stock gains up in price on my put, which Mark was referring to, but I'm getting no more positive profit on the call side because the delta is getting close to 1. So any gain I have in the stock near expiration is countered by the increased price on the call that I'd have to buy back. But we've got 3 legs involved, and one of them is still losing as the stock's going up and not being countered. This is a married put with income method number one. And this is the problem that Mark is discussing, that it tails off from here, and sometimes it's even much steeper if it's done not following the rules in the blueprint. It's done too soon or too short of an expiration, trying to force a weekly call against it, and you don't get a lot of price involved in that position. Now, another approach that I've already used, as I mentioned to Mark, but let's look at it in the aspect here of this position. We've had the original cost basis of 63.03 from the stock and the put. We get $1.70 for the call, so we've lowered the cost basis down to $6,133 with the potential to make a 7%. Worst case scenario is lose 2.2%. Stock rockets up in price and goes to 68.69. And Mark's saying, well, in that situation, why not move the put up? Okay, what would that do? Why can't we just move the put up to help the upside? Because it does the opposite. And what I mean by that, Mark, is that when I roll my put, July? Yeah. If I roll my put now from the 60 to the 65, because the stock is getting closer to $65, and I'm worried, or if it's going to 66 or 68, we have to remember, oh, I'm sorry. Oh, yeah, 60 and 65. That's interesting. It didn't add it. There we go. I'm sorry. When I sell to close my 60 put, and buy the 65, that's going to be done at a debit, which is going to do what, Mark? It's going to increase my cost basis. But I still have an obligation at the 65 strike, which means this return is going to lower, not increase. And because the cost is increasing, this slope downwards should increase as well. Let's take a look. So what am I doing? I'm selling to close my 60, buying to open the 65. It's only a debit of about $2. Not bad at all for a 5-point increase. But now that's what I get. The turn drops down to 6.8% from 7.3. Yes, I'm bulletproof now, but look at how steep the fall off is. Because now I'm at the same strike at 65 with the call and the put. The debit increase lowered the max potential profit, and the fall off is steeper now because of the higher cost basis and having the 2 strike prices, Mark. In any situation, when I tell any blueprint owner or radioactive trader, if I've got an income method number 1 in place against a married put, and the stock is moving up, and they say, should I roll my call and then roll the put? Let me roll the put first and then see what I stand. My answer is always take care of the call first. That's actually hurting your position more than the put is. In that original income method number 1 we were looking at, Mark, as the stock continued to move up, what's hurting the position more is the sold call, not the long put. Okay, the short call is the one that's counters. We'd want to roll that up first, then evaluate the put to lower the risk. This did get me to a bulletproof status, but I don't like, and 6.8% is not bad, but this is too rapid of a trail off. That's too close of a trail off here on the profit and loss, where I start to go back to only half of the gain I could have had, or half the gain I might even have now, and then a third of it if it just keeps going up to 72, 73, or if it keeps falling down to 56 or so because, near the earnings. Now, I know you wouldn't do that to your earnings, but I'm just saying that's the effect of rolling the put up when you already have a call in place. You increase the cost basis because it's always done at a debit, Mark. And then, of course, you end up taking off the top for the potential profit. You see a steeper slope in both directions when you start to give back money because the delta of the call is going to 1. Why is it steeper? Exactly what I mentioned before. We had the 60 put. I said our delta was probably now at around 0.4, maybe 0.35 with the stock at 64.75. When I go up to the 65 now and increase the total cost basis, this delta here is probably at 0.55. So now as the stock moves up and my call delta is going to 1, I'm losing 55, 56 cents for every dollar the stock goes up on the put, not 40 or 30 cents. So that slope is much steeper, and I'm not getting anything back because the obligation is a short call. So we increased the delta of the put, which increases the downward slope as the stock starts to move up with that income method number 1 in place. Related to your other comment that we won't get to show today, that's more for a blueprint owner special. I've never had a lot of personal luck converting a sold call that's in the money into the ratio spread that you mentioned, the IM number 5 position. I haven't had a lot of the math work out for me. Usually what I have to do is roll this from a 1 to a new strike price that's at the money, but rolling it to an income method number 5. Doesn't always work out because you're getting such little net credit that the debit to close this position, and then doing the 5 and only getting 20 cents back with the potential to make more because the ratio call spread effect, that's when you potentially, it might make a higher profit, but then the risk actually increases because you're not getting a good credit ratio out of that. From where I originally sold the call, now I have to roll it up because it's moved up, then take a smaller premium because I'm trying to force this ratio spread. That starts to increase the risk. And that might be okay, depending on your outlook, Mark. But this is what we typically see. When you roll the put up with already having income method number 1, increase the cost basis, lower that max potential return, because now you've increased the delta on the put as it starts going above that short call you had in place. Again, the short call is hurting the position more. You're now giving back 55, 56 cents or so for every dollar this dollar goes up, as opposed to because your call delta is at 1. All right. So that's how I see it, Mark. Whenever I'm presented this issue or this situation from a blueprint owner, I always tell them that you want to look at adjusting the call first, because eventually that's when it's going to start hindering the problem as it goes deeper in the money. That's what's going to hinder the position the most as it starts going deeper in the money. Adjust the call first, then evaluate after you adjust the call what the put could do.